I think first thing is, if you are looking at trend trading strategy, a lot of people will just look at identifying the major trend first. One of the key ways of doing it, easiest ways to do it, is to just put on moving averages. So as long as candles are trading above the moving average, it tells you the market is bullish. But if the candles are trading below the moving averages, that tells you the market is actually on the downtrend. What I have here is on the daily chart for gold market, putting two exponential moving average. One is a 50 period, and another one is 200 period. So if you notice, currently the gold price is sitting comfortably above the 50 period EMA. So if it does that, that tells you the gold prices is actually, in the short term, is moving on a technical bearish trend. So in that sense, you should be careful. If the market also breaks the 200 period EMA, technically the market is heading on a technical downtrend. So we start to see a bit of weakness in the gold market in recent days because of the strong US dollar as well. So I think that's also keeping traders mindful as well. One of the ways to look at the trend of market is just to put a moving averages chart to look at it, to see whether the overall trend of market is bullish or bearish. So right now, for gold market, on a short term wise, it looks like it's going to be a technical bear because it's sitting on the 50 period EMA. Now, the second key important tools to use whenever I trade the gold market is to use Heiken Ashi. Now, if you are not familiar with Heiken Ashi, you can always Google it. Heiken Ashi is one type of Japanese candlesticks. Basically, it's actually using the average bar of a Japanese candles. The reason I like to use Heiken Ashi is because Japanese candlesticks requires a lot of interpretation. If you just read Steve Nissen's book, there's 100 over different setup, different types of Japanese candlesticks that you need to memorize. So it takes a lot of effort and time. Heiken Ashi is simple. You just need to remember 3 distinct patterns. Vice versa, if you see a red candle with no shadows, that tells you it's going to be a very bear trend, or the bearish trend is very strong. Now, if you see a series of small body red and green bars with long shadows, that tells you the market is actually on a sideways market. So if you see this during an uptrend, you should be careful, because that normally tells you the market bullish trend is actually finding lack of energy already. So it will turn anytime. So it's also considered a reversal pattern. So it's only these 3 distinct patterns that you need to take note whenever you use Heiken Ashi. So what I have here is basically the gold futures chart. Both of them are similar time frame. If you notice, I break it down to chart A and chart B. Now, if you just by the glance of it, if I ask you this question, which chart is better to trade? A lot of people will say, oh, I'll prefer chart B as compared to chart A. Reason being is because if you just look at chart B, if you see the green candles, you are taking a long position. If you see the red candles, you are taking short position. So in a way, you are staying with the trend longer, rather than if you just use a normal Japanese candlesticks, you get a lot of whipsaws, especially when the market is moving or going from a trend market to a sideways market. So Heiken Ashi helps you in identifying the trend of the market in an easier fashion. So just to share with you the dynamics, so as long as you see red Heiken Ashi bars, with best is with no shadows, then that will tell you the market is actually on a bearish trend. And when you start to see the candles, the body of the candles are getting smaller, and the series, that's red and green series, that tells you the bearish trend is actually getting tired. So that's where the market is going to a sideways market. So it's actually very simple. And in a way, a lot of traders will like to use this because it helps you to identify the trend in an easier and faster manner. So this is another example. You can clearly see candles, the body of the candle starts to get longer. So that tells you from a sideways market, the market actually may be trending. So once you can use other indicators to identify or to make sure your signals are more accurate. So once the red signal appear or red candles appear, that tells you generally the market is going to hit on a downtrend. And true enough, once the next candle bar that's formed is a strong red candle, that tells you, the market is heading on a bearish trend. Now, using Heiken Ashi itself may not be sufficient. What I did here also is to incorporate the moving average crossover. So what I normally do is that I always incorporate the 9 period EMA with the 20 period EMA. So crossovers are very easy. So when you see a bullish crossover for moving averages, that means the shorter period 9 period EMA is crossing above the longer 20 period EMA. Bearish crossovers are crossing below, the shorter term crossing below. So if you accompany that with Heiken Ashi bars, that will give you a better signal. So in this sense, you can clearly see when the green candle starts to appear, and if it's a bullish crossover on your EMAs, that could be a very good signal for you to take a long position. So here again, you can clearly see a good setup. The red Heiken Ashi bars are getting longer, and you just nicely see the EMAs is starting to point downwards. That means looks like it's going to be a bearish crossover, or in fact the candles are trading below both the moving averages. So this type of setups is a very good setup for you to go short because of the red Heiken Ashi bars and also the bearish crossovers. Now, at least in terms of technical strategy, is whichever setup that you use, you must always have a setup for you to manage your risk. Now, there's a couple of ways to measure stop loss. One of the ways that I always use is to use a technical tool called ATR, which stands for average true range. So what this average true range measures is the daily range or the period range of the particular candle. So in this case, if you just look at the gold futures, the ATR value is 7 points. So if you look at the signal, there's a strong signal, sell signal at this point because of the red Heiken Ashi bars, and the bars are trading below the candle, which is technically looking at the bearish crossover. So it's a very good signal for you to take a short position. So assuming you short at 2022, the ATR value is 7. So you should be putting a stop loss at 2029 and your profit level at 2008. Now, how do I derive the profit level? If you calculate, it's almost like 14 points. It's basically the 2 times of ATR. Now, profit level is also based on ATR, the ratio of 2 to 1. This ratio is all depending on you. If you are someone that can, you want a bit more, you want to minimize your risk, you can adjust based on the ATR. 2 to 1 is not fixed. It's actually up to the trader and also up to your preference. So here you can clearly see you have shorted where we have pointed out earlier. You continue to hold until you start to see a green candle, or you start to see the body of the candle starts to get smaller. That's where you start to take profit. So there's a couple of ways of doing it, but always make sure target profit is not as important as the level that you put your stop loss, because you don't want a situation whereby you are aggressive on your target profit, but your stop loss you didn't manage well, you can easily get stop out as well. So ATR is a very good way for you to manage your stop loss, because as market gets volatile, that's where it requires you to be giving a bit more buffer to for your stop loss, because you don't want to be putting a stop loss too tight. If you put too tight, market will obviously knock you off. So that's where you need to be careful as well. So why you should be looking at gold market, just to summarize, I think first thing is that just look at where we are inflation. You are in a market where the politics of the world is getting very intense, especially US and China. And obviously you have the Ukraine and Russia conflict. You are also in a period of time where inflation is, the risk of a recession is also increasing day by day. So I think all this is actually making the appeal of gold to be very interesting at this point in time. So if you are an investor who have not get exposure in the gold market, I believe it's kind of good time for you to look at the gold market. In fact, if you want to trade the gold market, it's also it's quite a good time for you to gain exposure. CME offers a lot of exposure in the gold market. You have obviously the big gold contract, you have the mini gold contract, and the latest addition, you have the micro contract. So a lot of people say, when they introduce a new micro contract, people always say, oh, the volume is actually very low and whatnot. But on the contrary, if you just look at on a daily basis, the micro gold contract actually traded close to 80 to 100,000 contracts easily on the front month contract. So there's no issue of liquidity. I think the market itself, if you talk about gold on the CME market, is actually very liquid. If you want to start getting exposure in the gold market, try the micro gold first, because I think this product itself is small contract,